We could be in for a 7th consecutive record high on the S&P 500. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, earnings show a clearer picture for some industries, but uncertainty remains as President Trump's tariff deadline nears. A surprise move at Novo Nordisk. The pharma giant picks an insider to help reverse its Wegovy slump. And the biggest rail deal ever. Union Pacific buys Norfolk Southern for $85 billion. Katie, what are you watching?
I'm watching shares of those companies. That is a deal that we have known is coming, and maybe we're seeing a little bit of sell on the news because shares of both companies lower right now. But to talk about this tie-up, it's poised to transform the North American rail market, marrying together Union Pacific's network across the western U.S. with Norfolk's East Coast routes. But of course, regulatory approval remains a hurdle, Matt Miller.
All right, we're going to talk to Lee Klaskow about that in just a little bit. Right now, I'm watching shares of Novo Nordisk plunging, losing more than a fifth of its value today after the company unexpectedly cut its full-year guidance. Wegovy sales continue to struggle. That news also dragging down rival Eli Lilly. You can see Lilly off in the pre-market 3.7%. And, of course, we have some C-suite changes at Novo as well, Katie.
Let's talk about it all with Bloomberg health reporter Damian Garde, who joins us at the desk. So let's talk about some numbers here when it comes to that slashed forecast for Novo. They see that this year's sales will grow 8% to 14%. Operating profit expands 10% to 16%. That compares to previous forecasts of 21% and 24%. So the new CEO that they just announced today, certainly a big job ahead of him.
Absolutely. And, as you mentioned, they basically are slashing in half their expected revenue growth for the year, which feels like a little bit pulling the Band-Aid off. We kind of knew where Wegovy, their banner GLP-1 product, was trending with respect to competition with Eli Lilly, but also there had been some concern about whether the ambitions the market had for the ultimate growth of those products was maybe a little overcooked. And we might be getting some confirmation of that now, which is probably why Lilly is trending down. But to your point, the new CEO has big shoes to fill in the form of his predecessor, who was forced out of the company just in May. But also, Novo is in a moment where they need to demonstrate to investors and to, frankly, like the nation of Denmark, where they are a banner company, that they can withstand these challenges and return to the kind of growth that they had previously forecast. I thought it was interesting. There was some analyst, I think, disappointment that Novo appointed an insider versus bringing someone from the outside, which I do understand where that comes from, but is maybe misunderstanding Novo as an organization, which is a very insular, might be too strong a term, but this is what they do.
Yeah. I mean, you think about the profile of the CEO who was forced out, Lars Froggaard Jorgensen. He had been at Novo for decades, too, I believe. Remember, he was forced out in May, and they pointed to the stock price declining 50% in a certain period in 12 months. But you take a look at shares this morning, down 21%. That looks even more dramatic.
Yeah, I mean, the stock rose exponentially under Lars Froggaard Jorgensen.
There you go.
We had to figure out a new name. Now, it's interesting that GLP-1s are kind of the problem for Novo Nordisk. Obviously, they were, also the savior of that company. But they're a problem as well for United Health. I see they say that GLP-1s are a $160 million headwind for the pharmacy unit. Overall, United Health declines to affirm long-term guidance. That's rough.
It's not what you want to see. I mean, speaking of ripping the Band-Aid off, United Health, in arguably a similar situation to Novo Nordisk, albeit at a greater scale, they today announced a long-term guidance that was below, or rather a full-year guidance that was below analyst expectations. And this is after they pulled their prior guidance, which was unprecedented for the company. And there's just been a series of superlative headlines in the negative direction for them all year long. What's interesting with United Health is that we're watching apparently this contagion spread across America's insurers, and that they are not alone. Their major peer companies have all similarly pulled guidance in recent years, citing basically changes to the Affordable Care Act, a crackdown in Medicaid spending, and just basically patients are demanding more care than they had previously anticipated, which is kind of an existential threat for these companies in that as insurers, they are supposed to see around corners and accurately price risk. Like that's literally their entire job. And we're finding out that time and again, they have failed to do so with these things that are driving them down.
Yeah, we've been devoting a lot of airtime to Centene and insurers in general.
True.
Damien Garde, great roundup. That, of course, is our Bloomberg News health reporter. And there are a lot of health headlines out today. You also have Merck making billions of dollars in cost cuts as it braces for competition from the loss of its Keytruda patent. Keytruda, remember, is the best-selling medicine in the world. The FDA says that patients who can walk are also allowed to take Sarepta's gene therapy. That's after the FDA requested that the company pause all shipments of the drug after 3 deaths. We've been following this story. Remember, shares of Sarepta plunged 36% on the 18th of July, and you can see they're up by that amount right now on that news.
Yeah, we'll continue to follow that for you, but I want to get to the big acquisition. Union Pacific is going to buy Norfolk Southern in a cash and stock transaction valued at $85 billion. That transforms the North American rail market. Bloomberg Intelligence senior logistics analyst Lee Klaskow joins us now. And Lee, this is just a huge deal. We saw it coming, didn't know all the details, and it isn't expected to close even until 2027, right? But what do we know so far?
Yeah, what we know so far is that Union Pacific and Norfolk Southern agreed on a transaction. The deal represents about a 25% premium over what the stock was trading at, Norfolk Southern was trading at. It's going to create the first single-line transcontinental network in the United States. This will bring with it a lot of operational benefits. And there's no doubt that, a single-line transcontinental network would be good not only for the railroad itself, but also probably good for shippers. But they have to prove their case to the regulators, the Surface Transportation Board, that this is in the public interest. And there are very high hurdles for large Class 1 railroad mergers to be approved, and the process is very, very timely for both rails. So that's why they're expecting this deal to close maybe early 2027, assuming they get that regulatory approval by the STB and other regulators.
Yeah, it'll be interesting to see if they get that blessing from regulators. Of course, that has ramifications for other railroad M&A we could see as well. But Lee, I want to get your thoughts on UPS. Shares down about 3% pre-market. They reported this morning, didn't give a forecast, and it seems like they're being punished for that.
Yeah, I mean, the economic uncertainty, that's nothing new, right? We've been talking about economic uncertainty since the tariffs started coming about. And that's really impacting, their business, and not only their business, but their ability to kind of predict where things are going to go. The reduction or the removal of the de minimis exemption also has negatively impacted the company. I guess the good news is that the company is doing what it can. They're continuing to restructure its network to deal with really the realities of its business, which is growth is going to come from e-commerce and business to consumer. Volumes tend to be lower margin business. So they really need to take costs out, realign their network, and that's kind of what they're doing. And then the slight miss this morning on their second quarter earnings was kind of driven by their domestic business, and that was slightly lower yields and slightly higher costs, and that kind of drove the miss this morning.
All right, great context as always, Lee. That is our Lee Klaskow from Bloomberg Intelligence. Let's get to an up arrow story. Another earnings story we're keeping an eye on this morning is JetBlue. Shares rising by about 4% before the bell. That's after the company said that it sees improving demand through the end of the year. For more, we're joined by Bloomberg's global aviation correspondent, Sid Phillip. And Sid, so it was still an adjusted loss, 16 cents a share, but that compares to a 33% average loss that was expected. And what's interesting is you think about the cadence of the second quarter, it got better as it went on.
It did. And so JetBlue is obviously scaled back. They sort of focused on their core markets of the Northeast and also the East Coast down to Florida. And that's what they sort of announced when they were strategically restructuring their business and focusing on just the profitable routes. And that's what they've been focusing on. And that's actually helped them reduce those losses and potentially get in a place where they're much more comfortable. And they've talked about how demand now is looking more bullish in the last 2 weeks. So they're talking about how things could actually be turning around there for them.
All right, speaking of turnarounds, Boeing's cash burn was exponentially better than had been anticipated, right? We were thinking they would lose multiples more than they did in terms of their cash burn.
Yeah, Boeing's actually a success story. I mean, they've actually managed to turn around in terms of just their deliveries. They managed to put a pin on their sort of losses that they'd been experiencing. They've been burning through lots of cash. I mean, they were expected to burn 1.8 billion. They only burned 200 million. And in terms of operating profit, operating cash flow, they've actually made money. So, I mean, for Boeing, Kelly Ortberg, the new CEO, is sort of putting them through the sort of turnaround process, and they're trying to get them across the line in terms of ramping up deliveries and making sure quality is on track. And that's what Boeing's really been focused on. And so far, that's been paying off. And especially with President Donald Trump using aircraft sales as a pitch for trade deals, that's actually working in favor of Boeing at the moment.
All right, Sid, thanks very much. Sid Phillip there covering airlines for us. Now, the IMF's new global economic projections are out, and the organization is forecasting 3% global growth in 2025 and 3.1% in 2026. That's a bump higher compared to the report that it put out after Liberation Day.
Right.
It's actually down if you look at it compared to the expectation from before those Trump tariffs initially hit.
It's interesting to see this forecast from the IMF because it kind of mirrors what we're seeing from corporate America. You have some companies coming out with new guidance that's lower than their previous guidance, but they had previously pulled guidance. So it's higher than it was, but still lower than maybe we started the year with.
Yeah, absolutely. We're going to break that all down with the chief economist of the IMF, an interview you don't want to miss with Pierre-Olivier Gourinchas, and that is at 10:40 New York time, so just about an hour and a half from now.
Yeah, looking forward to that conversation. But let's take a quick look at the setup. We are less than 20 minutes away from that opening bell, on track for what could be a seventh record high. The S&P 500 up about 0.2%. You can see it's big tech that's leading the way. The NASDAQ 100 up by about 0.4%. It's the small caps that are in charge right now, though, Matt Miller. The Russell 2000 higher by about 0.6%.
All right, coming up, U.S. and Chinese officials are starting a second day of talks aimed at extending their tariff truce. We'll head to Sweden for the latest next. This is Open Interest. Blackstone executive Wesley Lopatner was killed yesterday in the shootings at the firm's Manhattan headquarters. The gunman killed himself and 4 people in a shooting spree at 345 Park Avenue here in Manhattan. Let's go now live to the scene with Bloomberg's Miles Miller, who's been covering the story for us. Miles?
Yeah, and as you mentioned, Wesley was a rising star in real estate. She had spent quite a lot of time in that space, and here particularly at Blackstone, what we know is that she ran the REIT, the fund for wealthy investors, and focused on real estate. It appears as though she was shot as she was leaving the building here yesterday. We know that suspect rushed into the building after he parked his car in the middle of Park Avenue, pulled out an M4 rifle, and walked right into that building. He shot a cop in the lobby. He shot a security guard, shot Wesley, and another individual up on the floor where Rudin Management has an office. We are told that this all stems from his belief that he has CTE, which is degenerative disorder that a lot of football players have with close contact. He was actually targeting the NFL, but because there are multiple elevator banks here, he got on the wrong elevator. The NFL telling us this morning that one of their employees is among the people who were injured, but he's expected to survive.
All right, Miles, appreciate your reporting. That is Bloomberg's Miles Miller on the scene of yesterday's shooting. We will continue to follow that story throughout the day. But let's turn now to the trade talks underway in Stockholm. The U.S. and China are in their third round of talks, with the two countries looking to extend the 90-day tariff truce that expires in 2 weeks. Joining us now from Stockholm is Bloomberg's Oliver Crook. So this is the second day of the third round of negotiations. We know that neither side spoke to reporters after the first day concluded yesterday, Ollie. So what do we know about what's on the agenda of today's talks?
Yeah, so we know that they spoke for about 5 hours yesterday. This is a delegation led on the U.S. side by Treasury Secretary Scott Bessent, flanked by also Jameson Greer, the U.S. Trade Representative. And on the Chinese side, the Vice Premier, who have been speaking yesterday for 5 hours, as I mentioned. They're entering now hour 5 of discussions today. What we know is on the agenda is the potential to extend that trade truce that is currently holding between the United States and China. Remember, that trade war escalated to a point where both sides had tariffs of 125% on either side. That has come down from the U.S. side, now only has 30% tariffs on China. And what they need to do is potentially extend that another 90 days, because as you say, it's going to expire on October the 12th if they do not get to a conclusion, in order to hammer out some of the bigger issues that they have between the U.S. and China. These are a great litany of different trade issues, whether it's the trade balance. Obviously, this has been a centerpiece of the Trump administration's election campaign to right the world of trade, and certainly with China as sort of enemy number one on the question of trade. There's also the question of fentanyl. But there are a great many other issues. The fact that China still buys a lot of crude oil, natural gas from Russia, from Iran. The fact that, TikTok is still for sale in the United States. Trump says there's a buyer. They need a nod from Beijing. So these are going to be some of the conversations that they're going to be having and laying the groundwork for ultimately a framework for a full trade deal with the United States and China. That being said, this is likely going to be a meeting where they kick the can down the road, and that could be still a very long road going forward, because many of these issues are going to be very difficult to negotiate, particularly at a time when you contrast what we saw with the European Union and the United States. The Europeans really want to be seen to be giving Trump more than they're giving. The Chinese are the opposite. They want to be seen to be giving less than they are. So those conversations will likely be going on for some time now.
All right, Oliver, thanks very much. Bloomberg's Oliver Crook reporting live from Stockholm. Let's get to high interest now. A look at what else is making headlines around the world. Baker Hughes is betting big on data center demand. It's agreeing to buy Chart Industries for about $9.6 billion in cash, further solidifying its position in U.S. LNG services. The sector is set to boom, with exports of the fuel potentially doubling this decade. PayPal is boosting its earnings guidance for the year, but Wall Street analysts are disappointed with the company's slower payment volume and softer full-year outlook. TD Cowen says the results are healthy, but show limited upside. And Spotify swung to a loss in the second quarter, missing analysts' estimates after the music streaming service recorded higher than expected expenses related to employee compensation. Spotify is trying to compete more directly with YouTube by including videos on the service.
And coming up, investors have a high bar for earnings this quarter, with some companies that beat estimates and raising guidance still falling in the stock market. Could that happen to the Mag 7 stocks this week? We'll discuss next. This is Open Interest.
It's possible that this quarter, Meta may have spent as much on talent as it did on chips. Between the investments to hire Alexander Wang and the couple of folks out of SSRI, they may have spent close to $20 billion this quarter, which will be probably right around where they spend on CapEx.
That was Gil Loria on the show yesterday ahead of Meta and Microsoft earnings tomorrow. Let's bring in Bloomberg Tech co-host Caroline Hyde. And it's not just Meta and Microsoft this week. We also have Amazon and Apple. We were discussing this with our own Ryan Vlastelica, who was telling us when you take a look at the outlook, the M's look good, but it's a mixed picture when it comes to the A's.
It is. And even though, look, put it into context, Amazon is likely to post $160 billion worth of revenue in one quarter alone. The fact that we're expecting a 10% growth rate on that sort of sheer scale of revenue does show that tariff headwinds perhaps haven't hit them as hard as expected, given that many people flock to Amazon because they're deemed still a cheaper alternative. AWS is going to be front and center. Can they rinse out once again about 16% growth for cloud? How are they investing? And I think that's going to be the question for the other M's as well. Microsoft and Meta, are they upping the ante in terms of capex? You saw Alphabet up by $10 billion. What will Meta be spending? They're churning out about $40 billion in terms of revenue for the quarter. That's a growth rate of about 14%. Microsoft's about 14% as well, and they're pinning in about $72 billion of revenue. But both of them are now basically focused on hyperscaling. And what are we going to hear from Azure growth? Is that going to be 34, 35% growth? Is that cloud really offsetting what has been really a scramble to win the generative AI prize, it feels like?
Right. I mean, I was struck by Gil Luria's point, which again bears repeating, right? Facebook is going to spend $20 billion just to hire AI talent. Those are just that's just the human capital. So are we going to see the revenues match up to those kind of CapEx expenditures now, or is that expected to come later?
Well, this is the superintelligence lab's bet that they need to win at superintelligence. Why? Why does Meta need to see its advertising business model be enhanced by generative AI and win that race? Well, because they think in the context of the next few years, when generative AI takes over our landscape of content creation, you and I are going to need more connection. It might be with the generative AI avatar, or it might be with each other, but they need to see the underlying model be theirs, so it accentuates their own business proposal. And actually, Meta have done a great job at showing how Gen AI does drive their advertising business right now, does increase their revenues, and people have given them that winning formula. And therefore, we've actually seen the shares outperform. Both Meta and Microsoft have basically been the two key contributors to the S&P other than NVIDIA this year. People have loved it. Can they continue to win on that? But I think Apple's going to be the key one that you have to worry about. Look, they still bring in $90 billion worth of revenue per quarter, but their growth rate is about 4%. We're worried about what the pull forward means for the next fiscal quarter and where sales are going to be going in China in particular. Remember, they're closing one of their retail outlets there.
Yeah, Apple, one of the big problem childs when it comes to the Magnificent Seven. Caroline, great to preview it with you. That is Bloomberg Tech's Caroline Hyde. You can catch her at 11 a.m., but don't go anywhere because we have the opening bell just 4 minutes away. You can see we have green on the screen. We'll begin the trading day with Katerina, Simonetti of Morgan Stanley next. This is Open Interest.
We are moments away from the start of trading, and we could see a 7th consecutive record high on the S&P. Welcome back to Open Interest. I'm Matt Miller. You can see futures pointing higher on the S&P, the NASDAQ, and the Russell. You're about to hear and see the opening bell at the New York Stock Exchange. Evolent ringing the bell. The stock actually down about 15% over the past 5 years because it came crashing down at the end of 2024. But their ticker is EVH, which is very cool. At the NASDAQ, you see Salmon's Retirement Solutions ringing the opening bell. They have some kind of annuity that's brought them into some kind of index. I'm not really clear on that. But Katie, you're watching a shortage or a lack of orders at Wegovy pulling down Novo Nordisk.
Yeah, absolutely. I have my eyes trained on what's going on in Novo Nordisk right now, unexpectedly cutting its full-year guidance as Wegovy sales struggle. It wasn't supposed to report earnings until next week, but we got the numbers today. It also announced a new CEO from within the organization. We were talking about this with Damien Garde, that maybe there's some disappointment that it was an insider CEO rather than someone external. But in any case, you wrap it all together. Shares down 21% at the opening bell, Matt Miller. Through yesterday's close, Novo shares were down about 43% year to date. So, boy, just a wipeout underway.
Yeah, absolutely dramatic in terms of the reduction in market cap, losing a fifth in one day. Union Pacific is going to buy Norfolk Southern in what stands to be a dramatic deal for the rail industry. Its largest ever, $72 billion in cash and stock to buy that. It is, of course, subject to regulatory approval. They don't expect the deal to close until 2027, but just a huge reshaping of U.S. transit in terms of ownership. Also, Morgan Stanley's Mike Wilson is, as we told you yesterday, leaning towards the bullish side of his call for the S&P 500. His team believes the S&P will hit 7,200 by mid-2026. He explained it this morning on Bloomberg Surveillance.
The main reason we're bullish, okay, is that the earnings revision breadth has exploded higher off of what was, a deep cyclical low that basically priced in a recession for the most part. So that revision breadth is guiding us to the performance that we've seen. You know the rolling recession call that we've kind of been talking about. Well, now it looks to us like we're having a rolling recovery, okay? And that will be further spurred by the Fed cutting rates at some point in the next year.
Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager Katerina Simonetti joins us now. And Katerina, it doesn't appear that Mike Wilson and his team are at all deterred by an uncertainty of the Trump tariffs. In fact, maybe they're sort of consoled by the fact that that uncertainty is dissipating. Is that how you see it?
Well, Matt and Katie, thank you for having me on the show. It certainly is a good sound for Mike, who tends to be more bearish. But, they're seeing a lot of positives in the market. And belief, of course, seems to be that the tariff policy is going to be resolved. But I would say that, the better way to describe this stance as cautiously optimistic, as we definitely see some positive tailwinds that are helping the economy. And the fact is that the economy has proven to be significantly more resilient than previously expected. With that said, there are certainly a lot of there are a lot of uncertainties still on the table, and the tariff policy is unresolved. So it is a bit preemptive to declare victory, but we do think that we're going to get some clarity on it, and economy is positioned for growth, specifically for 2026.
I hear what you're saying, Katerina, that the economy has been resilient so far, certainly at the index level on the S&P 500, hitting all-time high after all-time high. You're seeing that strength there. But then you take a look at some of the headlines that we're getting out of this earnings season. Just from today, UPS pulling its guidance, Whirlpool cutting its guidance, and then you have Stellantis also warning about that 1.5 billion euro toll that it's going to take. It seems like, okay, the index level, smooth sailing, but you look under the surface, you look at these individual names, it's a much different story.
It is a much different story, and the earnings revisions are certainly not broad, but this presents unique buying opportunities for investors. Market is hitting new highs, and investors are starting to worry whether they should worry about tariffs or missing the market growth. We think the actual growth is on the stock level, where we're looking for companies that are positioned for growth, where earnings are actually positive versus the ones that are not, that are showing competitive advantage, and in the areas like financials, like industrials, and infrastructure, and of course tech.
What are the sectors that you don't like right now, Katerina? Which ones are losing out?
Matt, we're certainly very cautious of healthcare right now, as they're subject to policy uncertainty. And this is not to say that there are not great buying opportunities in healthcare. Investors just need to give themselves a longer time horizon for things to play out. But this is where, once again, it's a stock picker's market, and we tell investors to be cautious. We're also expecting that there is a very strong potential that there might be a market pullback in the third quarter, which is natural after the gains in the rally that we're seeing right now. So buying opportunities are there, but as Katie said, we're seeing the appreciation and growth on the index level more so than on the individual level right now.
I want to talk about healthcare a little bit more, because as a sector, that's down 3% year to date. That is the worst performing sector of 11 on the S&P 500. We know that the insurers are a basket of snakes right now, and even the bright spots of the health industry, you think about the GLP-1 makers, also running into a wall here. Katerina, you mentioned you have a long timeline. You have to have a long timeline to be bullish on healthcare. It sounds like it's too long for you. How long is that timeline, though, if you're someone who is interested in healthcare?
Well, this is where it is important to be selective. And there is a difference between healthcare stocks like hospitals versus insurance providers versus the big pharma. And we have to focus on individual companies and make sure that we're making appropriate selections. When it comes to a time horizon, of course, we are so spoiled by the need to receive the returns within months. The horizon used to be in years, and now we're looking at 3 months, 6 months. months out. But I would say 12 months plus would be a reasonable expectation, for something that has a longer time horizon for sure.
Instant gratification. That's what I'm in the market for.
Yeah, me too.
Yeah. All right. That's why we're in live television.
Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager Katerina Simonetti.
Let's talk about the index level. As we were saying with Katerina, it's been very resilient, and you can see that resilience today. The S&P 500 higher by about 0.2%. If that holds, that'll be the 7th straight day of record gains for this index. So keep your eyes trained there. We take a look at the setup right now, the breakdown of the individual names, and breadth looks pretty good at the moment. More than 300 names in the green, and it's the names that you need. NVIDIA leading the way here, higher by about 1.3%. You also have Microsoft higher ahead of its earnings, Broadcom higher as well. Then you take a look at the downside, and it gets very interesting. It's healthcare. We were just picking on the healthcare sector, and for good reason. Eli Lilly leading losses on the S&P 500 right now, falling in sympathy with Novo Nordisk. Of course, that is a Danish company. It's not in the S&P 500, but some worries there when it comes to GLP-1s. And that's what you're going to see on the sector breakdown as well. Pretty good breadth, not as strong as you might expect looking at the individual breakdown, but tech in charge, that sector up by more than 1%. You go down to the bottom, consumer discretionary, materials, and healthcare leading the way lower, down about 1.4% as a sector, Matt.
All right. Very interesting moves in this market. And if it holds, of course, these gains will be a 7th consecutive record high for the S&P 500. Coming up, Boeing almost halted its cash burn in the second quarter, a signal its turnaround is paying off. We'll speak with Ron Epstein, BofA Aerospace and Defense Analyst, about that next. This is Open Interest.
Welcome back to Open Interest. It's time now for top calls. Some of the analyst action in focus this morning. And first up, RBC Capital downgrading Domino's Pizza, saying it's at risk for slowing sales next year. Shares down a bit on that call. Next up, Sarepta, though, getting raised to a buy over at Oppenheimer. The biotech notching a major win yesterday after the FDA reversed course and recommended that some patients can resume taking the company's gene therapy. Remember that 2 weeks ago, regulators requested that the company pause all shipments of its drug after 3 deaths were linked to that treatment. Shares up 21% at the moment. And finally, we have Whirlpool getting cut to a sell over at Bank of America. The appliance maker slashed its full year earnings forecast, shares down about 9%. Meanwhile, let's turn our attention to the sky because Boeing reported negative free cash flow of $200 million. That is far better than the expected $1.8 billion. Let's discuss with Bank of America's senior aerospace and defense analyst, Ron Epstein. He has a buy rating on Boeing with a $260 price target. And Ron, we have to start with the cash burn, because I think that was one of the big surprises from that earnings report, that it was so much less than expected.
Yeah, good morning, and thank you for having me. Boeing's cash burn was far less than we were expecting, and I think the consensus was expecting. Minus $200 million is almost break even in the quarter, and as you mentioned, the street was expecting minus almost $2 billion, right? So we were looking for about negative $1.5 billion. So the cash burn was great, because it was almost negligible. It was driven by inventories coming down and some accounts payable. So the working capital management seems to be going in the right direction. I think it is evidence that the company is beginning to turn the corner. I do appreciate that the company has come out and said, hey, you know what? This is just a first step in a process. We got a ways to go. So, they're not taking a big victory lap here. They're doing the right thing and saying, hey, we got a lot to do. There was other really good highlights in the quarter. If you look at 737, they've suggested that they're going to work with the FAA this upcoming quarter to try to get approval to go to 42 per month. They're currently capped at 38 per month. They have certain metrics that they have to share with the FAA, and once the FAA is comfortable with that, they'll go to 42 per month. That's a step in the right direction. I mean, ultimately, we're expecting them to be in the high 40s by the end of next year, and then ultimately get into somewhere in the mid 50s. Maybe 2 years down the road. It's going in the right direction. 787 deliveries in the quarter were good. They're saying 787 production rates are at almost 7 per month now. That's a great place to be. We're expecting that to get to 10, by sometime late next year. So the commercial business does seem to be tracking in the right direction. I mean, the only really negative thing that kind of came out was, Kelly Ortberg, told folks that, the certification of the 737-7 and the -10, they're two variants that are kind of tied up in some engine icing certification issues, that might slip into next year. I would imagine on the earnings call they'll probably talk a little bit more about that, but that does seem manageable. And then even on the defense business, things seem to be tracking okay. And in their services business, things seem to be tracking okay. So, this is probably one of the best quarters Boeing's had in a long time. But like I said, the company doesn't seem to be taking a victory lap. It's just a step, in the right direction, and they have more steps to take.
It's a tough company to analyze, I guess, a stock especially, right, Ron? Because if they have an issue with the 737, or if they have an issue, God forbid, with a 787, that's not anything that Kelly Ortberg has done now. That typically comes from, could be years in the past, and that will crater the stock. How do you deal with that kind of uncertainty?
Well, I mean, it's a very good question. We deal with that all the time. As an example, what happened with Air India, I mean, there was a lot of fear that, maybe there was something wrong with the 78. Turns out, at least the preliminary investigation suggests that there's not. But that is one of the risks that you deal with a company like Boeing. Not specific to Boeing, but, they have, a couple products that are pretty high profile. However, we are confident, and we're seeing it, that the culture in the company is changing. We've written a lot about the culture of Boeing and how it needed to change, and it does seem they're taking steps in the right direction there. And if the culture moves in the right direction, everything else will follow. Mm-hmm. If you asked me 15 years ago about this sort of stuff, I'd probably just be looking at the financials, but the culture matters so much, and the culture's going the right way.
Well, Ron, to that point on culture, let's talk about the workforce a little bit, because Boeing is facing another strike potentially next week. Remember, members of its central U.S. workers union actually rejected a contract offer this past Sunday. How are you thinking about that as you read through these numbers?
Yeah, so, I mean, clearly it's a setback for their defense business. So it's the union in St. Louis and St. Charles, Missouri. Those are the machinists that work on, largely fighter aircraft, tactical aircraft. There's about 3,000 members in that union. The commercial strike that happened earlier in the year, that was, actually last year, that was 30,000. So it's, it's an order of magnitude smaller. I do expect that it will get resolved. And I don't see it as a big setback. However, they do have to work through it. I would imagine it gets resolved in a matter of weeks, not months. But we'll see, right? So it's something that has to get resolved. But I would imagine it would.
All right, Ron, really appreciate it. Ron Epstein there, Bank of America, senior aerospace and defense analyst, talking to us about Boeing with a $260 price target.
Yeah.
33%.
Boeing's shares up 33% year to date. It's actually one of this year's winners, which is amazing. You think about what a rough stretch they had in 2024, falling about 32% last year. But if these gains hold through the end of the year, they'll end out just about even.
All right. Cutting away all the losses. That's great. Coming up, Stellantis feels the tariff squeeze. It already had a rough first half, and it's predicting more than $1 billion in losses due to tariffs in the second half. That's next. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what stocks are doing right now. We're still looking at gains. but they're slight on the S&P 500, 0.1% to 63.96, or just shy of 6,400. If we close higher today, it'll be the 7th consecutive day of record highs for the S&P 500. The Nasdaq gaining a little bit more here. We can see that Nvidia is helping us out today, up more than 1% for a $4 trillion company. That really moves the needle. Meta is little changed, but down. We expect earnings from Meta, Microsoft, Amazon, and Apple all this week. UPS disappoints with a drop of 8%. Norfolk Southern making a deal for $72 billion, and investors don't like to see that kind of cash and equity spent necessarily. Boeing, we just talked about, actually down 2%, even though Ron Epstein is fairly positive on the stock. And then Stellantis, not moving by much, but the company warned that it expects the new higher tariff dynamic to hit it to the tune of $1.7 billion. That's in the second half after losing a couple billion in the first half. Let's get into the numbers right now with Bloomberg's autos reporter, Gabriella Coppola. Gabby, great to have you on the program. What do we know about this new tariff regime? Because on the one hand, it's going to hit them with 15% on everything they import to the U.S. from Europe. On the other hand, they don't have to pay 50% steel and aluminum taxes on those cars, or any kind of fentanyl taxes or USMCA issues. They just get to bring it in with a clean 15%.
Hey, Matt, I think, Stellantis is clearly still feeling a lot of tariff pain, and it is going to hurt them when they import cars from Europe. But also, they're not scot-free when it comes to Mexico and Canada. And I think a really critical example of that is the new Jeep Cherokee. This is a midsize SUV that has been out of the market for 2 years. When you want to understand why Stellantis is struggling to get its mojo back as much as it is, it's because there's so many product gaps in the lineup. The Jeep Cherokee, the previous CEO, Carlos Tavares, decided to move it from Illinois to Mexico. Then Trump got elected and he slapped a big tariff on Mexico. So the new CEO, Antonio Filosa, this was his debut kind of appearance on Wall Street talking to investors. He was asked specifically, how are you going to make money on the Jeep Cherokee when you're facing these tariffs in Mexico? And he said, we are working on the platform, trying to find new ways to take out costs so that we can launch this vehicle. And I cannot stress how critical this vehicle is for them getting back to growth in the U.S., which is their most important market.
Yeah, it's interesting. Last year or the year before even, they killed the Hemi, which is like the most Mopar thing that you could possibly ever buy. There were no more Chryslers for sale, like at all, after the 300 was done, right? And when Tavares left, they took forever to replace the CEO. Why did they take so long in doing all of this stuff and bringing back the 6.4 liter V8?
Yeah, I think, I think that Wall Street and perhaps the public have underestimated the damage that Tavares did. He just produced these BofA profits for so long, and Wall Street thought he was a genius. Meanwhile, he was doing lots of short-term things that long-term hurt the company. And when you retire the Hemi engine, you don't just flip a switch tomorrow and bring it back. I mean, Tim Kuniskis, who had left the company briefly, he's back. He was the head of Ram. Now he's in head of all brands in the U.S. So they're working very hard to bring back some of the stuff that their core American consumers love, bringing back the Hemi engine in the Ram truck. They had retired gas-powered Dodge muscle cars, the Dodge Charger and Challenger. Those are halo vehicles that just really define the brand. They have an electric one right now that's made in Canada that's selling, it's tough. EVs, it's expensive. EVs are not selling great. So it's just taking a long time for them to get these products back in the market. I do think that Trump's agenda in Washington of zeroing out fines for fuel economy, they talked about that. They do have more flexibility now to sell the cars that they make money on. But basically, it's very quick it's very fast. You can destroy your market share pretty quickly, and then it takes a long time to crawl back and get it back. And they're crawling, and I don't think people appreciate how long that takes.
Well, hopefully they get up and walk again soon. Gabriella Coppola talking about Stellantis. Thanks very much. We come back, the CEO of CalPERS, the largest public pension fund in the country, joins the show. We are like 30 minutes into the trading day. Looking at gains here again today, 6,400, the level on the S&P 500. If we close at this level, it will be a 7th consecutive record high for the benchmark index. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. I have to say, it's underwhelming, of course, these record highs that we're seeing. Such small moves overall, but I guess it doesn't matter when you add up the superlatives and you take a look at the long-term chart.
Yeah, I think long investors are certainly happy. We're also getting some breaking economic news across the Bloomberg terminal right now in the form of JOLTS job openings, slightly less than what had been anticipated and far less than we saw in the prior reading. Let's get over to Michael McKee, Bloomberg's international economics and policy correspondent. He's got the numbers and the details. Mike, what do you see?
Well, your number is 7,437,000. That is down, as you say, Matt, from 7,769,000. Now, does that really matter? It's not a significant move. What has surprised analysts is that the openings have stayed this high, given the fact that companies say they are not, at this point, looking to hire anybody. The quits level is down just a tenth. It's at 2%. Well, actually, revised, it's the same as last month, 2%. We had seen a tick up in the initial number. So right now, it looks like it's status quo on the JOLTS level. Now, these are June numbers, so they matter a lot less to the Fed than they used to, especially because people can't figure out exactly why we're seeing what we're seeing. Now, the conference board number is interesting. Comes in at 97.2. That's up from 95.2 last month, and it compares with the 96 that was forecast. So we're seeing a lot more confidence than maybe people had anticipated. And when you're looking at the present situation, it's up 131.5. Well, again, I get caught by the revisions. It was 133 last month, falls to 131.5. The initial report last month was 129. So let me do this carefully for expectations. Expectations do rise to 74.4 from 69.9. Now, does that mean a whole lot? The correlation between consumer confidence and spending is not particularly strong. It's driven a lot by whether or not people think jobs are going to be plentiful or not. And the number of people who think that falls to 29.2% from 31.1%. Jobs hard to get. 18.1 from 18.4. So people still thinking that the labor market is okay, but starting to deteriorate. Now, the interesting number that I see from all of this is when you look at the number of people who are reporting what they're going to buy. This is what I wanted to watch for, because in June we saw a drop in the number of people who wanted air conditioners, and now we see a continued drop in the number of people who want air conditioners. 3.2% from
as 200. Michael Barr tells me 200 million people in these United States of America are under a heat advisory right now.
I know. This is what I expected, a big change. So this obviously is going to affect everything the Fed does today and tomorrow. Well, if the air conditioning went out, it sure would. but yeah, that's interesting. We see people, the number of people who want to buy homes falls. Number of people who are planning to buy cars falls. So it's.
What about motorcycles? Is there How many people want to buy a
I don't
Harley
see
Davidson?
a breakdown for that.
At least one, and he's sitting to my right.
Yeah.
All right.
Mike McKee, thanks very much for that roundup. Mike McKee rounding up the JOLTS and confidence numbers. Now, CalPERS is the largest public pension fund in the United States. It's been leaning more and more into private investments, and that has some former board members concerned. Margaret Brown specifically, who now runs Retired Public Employees Association of California, told the FT, quote, "I have grave concerns that CalPERS plans to double down on private equity. It's far too much risk for a public pension fund that millions of retirees depend on." All right, so we'll ask the opinion of the CEO of CalPERS, Marcie Frost. We're lucky enough to have her on the program with us now. Marcie, thanks so much for joining us. What do you think about those concerns? Because they are shared by other critics. Are you going too deep into private markets?
Mm-hmm. Well, private markets has definitely been one of our best performing asset classes as you look over a 1 year period of time, 5, 10, 20-year period of time. It's also a time that retail investors, frankly, are going to have much better access to, say, private equity in the private markets. And so for CalPERS, we still have very strong conviction in private equity, and we do expect that it will tick up a bit in 2026. But the returns, I've said this on record before, there's no reason that our members should also have access to outsized returns. And we are as transparent as we possibly can be in a private market setting. We co-founded the Data Convergence Initiative, which is all about getting better data out of the portfolio companies and the general partners in which we're investing in. So CalPERS has a very strong understanding of the fees that we're paying. We've seen a 10% reduction over the last 2.5 years in those fees. That has been a concern of some of the private equity critics as well. We do a lot through co-investments and separately managed accounts to get those reductions in fees. But again, we have very strong conviction the team is doing an excellent job. And, you know, there's such wide dispersion in private equity in particular. And so finding the best managers in which we put our capital into, we spend a lot of time making sure that we're doing absolute due diligence on those managers, that we have the transparency internally to the teams to be making the call on that cost of capital, the illiquidity premium, which again, I think critics are a little concerned about, you know, money not flowing back in. But CalPERS is in a very strong liquidity position. Can't really comment or speculate how our counterparts might be, but I think we have been differentiated because of our liquidity position.
Well, let's talk a little bit about the context here, because in March last year, CalPERS increased its target private equity allocation from 13% to 17%. You take a look at the average allocation to private companies among some of your peers, U.S. public pension funds. It's about 10% right now. That is according to the National Conference on Public Employee Retirement Systems Trade Association. When you add in your private equity exposure with your private debt exposure, that comes out to about 27% of the portfolio. Overall, taking a look at the totality of your private investments, does 27% sound about right? What is your overall target?
Mm-hmm. It does sound right to us. And again, I can only speak to the strengths that I believe that we have at CalPERS. We're a long-term investor. We have a very strong liquidity position, which allows the allocation to private equity and private debt to tick up a bit, capture those outsized returns that we've seen certainly over those longer periods of time. Now, if we were in a different liquidity position, then we would have to rethink that allocation target. But many of our peers are not as liquidity fluid as we are. They're a little more constrained. But we're in this excellent position to capture those outsized returns for our members. And we think that the allocation that we have in place works for us over the next 4 to 6 years.
I'm glad we're talking about liquidity, because I think that's where a lot of the concern over private investments comes into play, that if there are withdrawals, if we're talking about illiquid assets, it's going to be hard to meet those redemptions. And to that point, Marcie, what do your yearly withdrawal obligations look like? Are we talking about 5% per year? Are we talking about something closer to 20% per year?
Yeah. So our payroll, if you will, this is the money that's going out of the fund, is about $30 billion per year on a $550 billion portfolio. But again, the liquidity coming in from the contributions being paid by our public employers, the contributions that are paid from our members, we're fairly cash flow neutral. So again, very strong position on liquidity. And if we didn't have conviction in the asset class, or we had some concerns about our liquidity position, and we have liquidity management processes within our investment office, we have very strong valuation processes within our investment office, that we think that this is the right place for us to be for now.
How is your liquidity profile so strong, especially when you're that deep into private markets?
So we are an underfunded system. So we have roughly, as of our returns, which were 11.6 reported at the end of the fiscal year on June 30th of this year, the liquidity position is coming in through those contributions that are being paid on the unfunded liability, paid by predominantly our public employers, about 3,000 of those, and then the contributions coming in from our members. And remember, our new tier that's called PEPRA, the new tier is a 50-50 normal cost share. So we have 50% coming from the public employers and 50% coming from our, the members that are in PEPRA. So the liquidity is coming through a lot of contributions, coming through the returns, of course, that we're getting on the current assets, but we're fairly liquidity or fairly cash flow neutral at this point. But again, that would be a marker that we will watch over time as the funded status increases, which it will increase. It's increased by about 15 points over the last 9 years, something that we're quite proud of. It's something that our members pay very close attention to. And so we will monitor that very closely to make sure that the cash flow matches up with the liquidity positions, those returns on capital. But again, this is managed very, very carefully by a very talented team within our investment office.
And a new CIO there, Stephen Gilmore, to help drive those returns as well. Hey, Marcie, I want to ask about the goals of your investors. The retirees that you're working for have to align to some extent with, I guess, the investments that you make. So the last time you were on, you talked about getting your investment firms to sign on to labor principles to make sure that they treat their employees fairly and well. Have you been able to really, do you think, affect change there? And has it affected at all your returns?
Mm-hmm. So the labor principles we have implemented across every asset class that we have at CalPERS. We started on our private equity team, and all going forward managers where we will be doing allocations to have all signed on to those labor principles. We're working through some of our fixed income managers and some of our public equity managers, but the number is around 95% of every manager that we're allocating to have signed on to these labor principles. The AIC is actually signed on, maybe not fully to our labor principles, but it's a restatement of what the AIC has already signed on to. So all the private equity managers understand that these are basic expectations from an LP like CalPERS. And frankly, I think any LP would have these expectations about how workers are treated, worker safety, a workplace free of harassment. So what it has created for us is it set the expectation very clearly. There's no confusion about the expectation. It allows an engagement process when we hear and we get stakeholders showing up at our public meetings here in Sacramento. They also have the ability to dial into these meetings and make a complaint or express a concern about a company that we're invested in, whether that's Tesla, whether that is an Exxon, it might be a private equity company. And so we can take that information and we can engage with that public company or that private company and figure out, whether there's any grounds to the complaint. If there is it a violation of one of the labor principles? If it is, what's the cure for that labor principle? So again, set expectations clearly, helps us with accountability, keeping everyone straight. But again, these are a restatement of U.S. laws for the most part.
I do want to talk a little bit more about public and private investments in your portfolio, because I'm taking a look at your performance. It looks like the private equity portion of the portfolio, that's about 18% of the fund. It delivered a return of 14.3%, which of course is impressive, and that's an improvement over the prior period. Then you take a look at how public equity investments perform. That is the lion's share of the fund. It looks like 39%. That actually outperformed all other asset classes, a 16.8% return. This is a question that I ask to pretty much every investor who's exposed to public and private markets, is whether the return that you're truly getting in private markets, whether that makes up for the liquidity that you're giving up there. And especially when you lay out the numbers like that, I do wonder how you start to tackle that question with that long-term conviction that you do have in private markets.
Mm-hmm. And so I think you hit it. We have a long-term conviction. We don't pay too much attention to one-year returns. We look at longer periods of time. We're an evergreen fund. We're here to pay benefits for generations of public sector workers. So we don't pay a lot of attention. And of course, I want to compliment all of our teams for this year's performance. But we're really careful about not putting too much attention on short-term performance. And so I think, again, if you look at the longer term, private equity has paid in the way that we would expect it to pay based on an illiquid illiquidity premium. And, I think there are some questions around whether that is enough, whether the illiquidity premium that we have in place today, is that enough to tie up that capital over long periods of time? These are issues that we certainly address on a regular basis and through our strategic asset allocation process that we've done, frankly, every 4 years with a revisit on a 2-year cycle. And probably should talk a little bit about Stephen Gilmore coming into the organization. He just completed his 1 year on the job from New Zealand, and working our board over the last year through a bit of an adjustment in the way that we look at how we allocate capital. And so moving from that pure strategic asset allocation, which is more, frankly, I think is more of a, set and forget. Everyone gets their, for simple terms, everyone gets their checkbook balance, and that's what they're allocated to, and they go out, and allocate appropriately to the balance that they have in that portfolio, whether that's 13% private equity, 17% private equity, 5% private debt, 8% private debt. What TPA does is provides a lot more transparency. It's something our stakeholders ask for on a regular basis to the board in public meetings and private meetings, more transparency about returns. So today, relative to benchmark for our stakeholders, that's a little more difficult to calculate the value add. But if we look at it from a total portfolio approach, which we've defined as the board choosing a reference portfolio and then a certain budget for active risk, that is how we've defined TPA with our board, and the board will be making a decision on, do they want to move from the strategic asset allocation process and protocols to something that is more dynamic, much more collaborative internally, but also much more transparent to our stakeholders who have asked, to understand how returns are calculated, to understand how returns are compared by asset class over periods of time. With a reference portfolio, which is a passive portfolio, it's going to be very clear when the team uses that active risk budget to outperform, publicly listed companies as an example. So I think these are good wins for the board. I think they're good wins for CalPERS around transparency, and I think it's something our stakeholders have been asking for.
Marcie, great to have you on the program. Really appreciate your time and hope to get you back soon. Marcie Frost there is the CEO of CalPERS, talking to us about her investments and her team. Coming up, the U.S. and China are back at the negotiating table, working to extend their tariff truce. We'll speak with Elliot Hentov, State Street's head of macro policy research, next. This is Open Interest. The U.S. and China continue trade talks in Stockholm. This is the third round of talks between the two countries in less than 3 months. Both sides are looking to extend the 90-day tariff truce that expires in 2 weeks. Bloomberg's Oliver Crook is in Stockholm. Oliver, what's the latest?
Yeah, that's right, Matt Miller. We are waiting here for potentially a press conference from the U.S. side of that delegation that is led by Scott Bessent, the U.S. Treasury Secretary, and Jamieson Greer, the U.S. Trade Representative. They've been locked in discussions with the Chinese Vice Premier for the last 2 days, 5 hours yesterday. They're closing in on 6 hours of their discussions today. And as you say, an ambition to try to extend the truce that is currently holding between the United States and China on the issue of trade. Remember, that is a trade war that escalated to tariffs of 125% that basically precluded any kind of trade between the two biggest economies in the world. What they would like to do is to extend that potentially for another 90 days. Remember, that is set to expire on August the 12th. In terms of getting an actual broader framework for a trade deal between the U.S. and the United States, we are still some distance away, but it'll be interesting to hear from the U.S. Treasury Secretary if these issues were brought up. The fentanyl precursors, the issue of TikTok, the question about the trade balances, and how do you actually close that trade surplus that China runs with the United States. These are all the things that we hope to hear from the U.S. Secretary in the next couple of hours.
Yeah, looking forward to those remarks. We appreciate the update. That is Bloomberg's Oliver Crook reporting live from Stockholm. And for more on the trade talks, I'm pleased to say, we're joined now by Elliot Hentov. He is head of macro policy research over at State Street. Great to have you with us, Elliot. I'm reading the notes that you sent over to our producer, and it seems like you're making the case that there's a bit of tariff fatigue, trade policy fatigue, when it comes to the overall state of these markets.
Yeah, I mean, just look at markets. The VIX is below 15. Risk assets have done really well. And why is that? I mean, if you track it since April 2nd, Liberation Day, kind of the sensitivity to trade policy has just declined and declined and declined. And I would even say that that entire uncertainty that we talked about for the past 180 days, policy uncertainty driving markets, that's kind of in the rearview mirror. We don't have policy uncertainty per se. We're now back to a more normal environment where it's all about tail risks, but you focus on kind of the core risks and opportunities that are driven by fundamentals and macro data. So a lot of this policy talk, I think, is going to shift into the backseat.
I thought it was interesting that Friedrich Merz, after the agreement with the EU, sort of hailed it at first and then criticized it on further consideration. How bad is that deal going to be for the EU economy? How bad is it going to be for the German economy in terms of a hit to GDP?
It's obviously it's worse than where Germany and Europe was trading 8 months ago, before the U.S. election. But it's better than the fears we had in the first week of April. And it's definitely better than the tail risks that we could have had, which was an escalating trade war. So on all things considered, it's a manageable shock. It's negative, but we estimate a shock to Euro area GDP of about 0.4%. That's not fun, but that's certainly manageable, and it's one that dissipates over the coming year. And in Europe specifically, we'll have an offset. We'll have a negative growth shock from this trade channel this year. And then next year, we have the fiscal bazooka gradually kicking in and delivering some outsized growth in Germany and beyond. I wouldn't lend too much credence to Merz's interpretation. I think there's a lot of local politics going into the rhetoric of how to criticize it and how to position. By and large, I think the EU probably did as well as it could have.
Elliot, how do you see that playing out in the global equity markets when we're talking about the European economy, maybe a shock this year, but maybe that fiscal bazooka coming in next year? We know that European equities have been outperforming those of U.S. equities year to date. Do you see that actually continuing?
Yeah, that depends on the time horizon. I think when we look into 2026, we could indeed have a repeat outperformance of Europe. I think in the near term, that is a little bit harder to imagine because now we have the trade shock. It is going to hurt. There will be reduced exports, margin compression, and so forth. And so Europe has to first get over that. So it's really a question of the time horizon. Short term, I would say no. But looking into 2026, we're more optimistic. From a macro perspective, I mean, we have penciled in the highest growth rate for the euro area in nearly a decade for 2026. It's only 1.5%, but that's the highest the area has achieved since 2017-18. And so on the back of that revival, we could have an equity performance that is quite impressive next year. But for now, I think we first have to kind of digest what we've just gotten.
U.S. markets continue to power higher, Elliot, but if you look at the U.S. year-to-date performance versus the rest of the world, particularly Europe, we're just not doing nearly as well, right? The DAX is up 22%. The IBEX 35 in Madrid is up 24%. And meanwhile, the S&P 500 is only up less than 9% year-to-date. Today, I think Peter Oppenheimer from Goldman Sachs is saying that, U.S. investors should really look to diversify out. But do you think U.S. markets catch up with those European high flyers?
Yeah, look, again, I think you do have to compare it to the a priori. Coming into this year, global asset allocators were extremely overweight U.S. equities. They were underweight pretty much everywhere else of the world. Some of them has been a normalization of positions, and that's partially reflects kind of the catch-up as money has flowed back into these regions, and where the conclusion of some of the policy actions, particularly in Europe, that obviously the outlook and the tailwinds have shifted and improved a little bit. But that said, if you look at where are global asset allocators today, on Europe, they're still roughly neutral. They are not necessarily overweight. There's certain sectors there they may be, but overall they're just back to neutral. So there's still some potential upside there from a fund or from a flow perspective if the fiscal story really materializes.
All right, Elliot, up against the clock. Have to leave it there. Really appreciate your time this morning. That is State Street's Elliot Hentov. And still ahead, the IMF warning the world economy will keep weakening even as it shows some resilience to trade disruption. We'll speak to the IMF's chief economist later this hour. This is Open Interest.
we're slowing down the hiring in jobs that are, quite frankly, soul-crushing jobs. Customer support, 80% of the customer inquiries and cases now are fully managed by agentic AI. And think about security and risk management in real time. All the patchwork and the change management is done by agents now. They work hard 24/7, you don't have to pay them, and they don't eat any lunch, and they don't have any health care benefits. So they're very affordable.
That was ServiceNow CEO Bill McDermott adding his voice to a growing chorus of leaders warning fewer humans will be needed as AI takes over. Reflexivity CEO Jan Szilagyi told us on Friday, for example, that fewer analysts will be needed on Wall Street as firms start to use his platform. So where else is AI going to drastically reduce headcount? For the answer, let's bring in Joe Kaiser. He is the CEO of growth stage VC firm Mercato Partners. Joe, thanks very much for joining us. Let me ask just that question. You know, where else do you see fewer and fewer humans needed as AI starts to take over our jobs?
Well, Matt, it's an interesting question because I think in the short run, we will see a preponderance of jobs impacted, right? So we'll not, I think a lot of the talk right now is about the entry-level jobs being eliminated. But I think it's also true that more senior jobs can also be eliminated, because if you think about what agents and AI in general can do, it can help a less experienced person perform at a more experienced person's level because of the knowledge that AI can bring to bear for anyone. But offsetting that, Matt, I think is we are on the cusp of a boom in small business and startups because of the barriers that agents and AI are eliminating.
Well, Joe, to that point, I wanted to ask, is this an investable theme? You talk about that boom coming when it comes to startups, small businesses. Is that where you're looking for opportunity right now?
Absolutely. So one company that I would mention that we've recently invested in, a company in Chicago called Artisight, is bringing AI to bear in both operating rooms and patient rooms. So if you think about a surgeon, a career surgeon might spend 40 to 50,000 hours in an operating room. The Artisight database has already ingested 2.5 million hours of operating room time and is bringing that intelligence and best practice to bear for surgeons and clinicians.
Where do you want to invest that's like the next growth area? I mean, I know you're already invested in a lot of companies like Mountain, which is how we know each other with Mark Douglas running that company. But what is the next frontier for you, Joe? I mean, you have a history in power development, for example.
Correct. Yeah. Yeah. So, Matt, I think that's a great point. And as President Trump talked about last week with the deployment of infrastructure and removing barriers to creating the infrastructure for our country to build out the necessary assets to support the AI data centers of the future. Over 100 power plants, for instance, are required over the next 10 years just to keep up with that. And then you think about what is the software required to deploy that power efficiently, I think is an interesting theme and investment opportunity as well. And then just in every facet, Matt, of business, I think AI is going to disrupt. And so, the story that comes to my mind, or the opportunity that comes to my mind, Chris Anderson, if you remember from Wired Magazine, in 2006 wrote a book called The Long Tail, and talking about how the internet was going to allow business to start reaching more demand, pockets of demand, different consumers. Well, AI just knocks down any barriers to reaching the furthest portions of the tail of demand.
We were talking about, Peter Oppenheimer from Goldman Sachs says you want to maybe diversify outside of the U.S. And I was just looking at returns for, the major continental indexes, almost all, except for the CAC, crushing the S&P. But in terms of the AI race, which was, I think, what President Trump's conference was called in Washington.
Winning
the AI race. Does anybody else hold a candle to the U.S.? I mean, are we outperforming every other competitor, including China?
We are outperforming today, Matt, for sure. I think, but this is this is a humanity race, right? Not just a U.S. versus another country or a set of countries race. So whether it's China, it's Europe, any other part of the world, AI is for the betterment of all humanity. But having said that, I think the U.S. has a lead today, and President Trump's desires to remove barriers to development as well as barriers to content to continue training models is required, I think, to keep us as a nation in the lead.
And so, Joe, I'm taking a look at your notes. I see that you're speaking to us from Texas right now, but you're based in Utah, I believe, and you call out specifically water scarcity. In this conversation around power, we know that water scarcity is an issue that is getting more and more attention. How does that factor into your world?
Well, it's, a lot of the conversation so far has been about the shortage of power and electricity available today and how that will, if not properly managed, can affect the homeowner. But I think the same holds true for water. The cooling of data centers today is done with water. And obviously we use water to produce crops and the food that we eat. So as that scarce resource becomes scarcer, it could have implications on the cost of food, for instance, and the cost of the water that we consume as humans. So I think that is something that we have to pay close attention to. But there are technologies that are not water-based that are in the development stages that should solve this over time.
All right, Joe, fascinating conversation. Hope to continue it soon. That is Joe Kaiser of Mercato Partners. Meanwhile, let's get a check on these public markets right now, Matt. You can see the S&P 500. It's still green, but not by very much, higher by about 0.1% on the S&P 500. Big tech, the slight outperformer here, as measured by the NASDAQ 100, ahead of some very consequential earnings, all as that bond market rally continues with 10-year yields falling another 5-6 basis points.
All right, so we still can hold out hope for another record close today. Of course, we still have quite a few hours to go.
Yeah, day's not over yet.
That 5.5 hours. Let's get a look at some of the single stock movers this hour. For that, we go to Bloomberg's asset reporter Denitsa Sikova over in the corner.
Let's start with Sarepta, one of the big gainers today. It comes after U.S. regulators reversed course, and now patients who can walk are allowed to take its gene therapy. Sarepta shares are up about 28% of the news. Of course, 10 days ago, FDA requested that the company pause all shipments. Then the drug, after 3 deaths, the company initially refused, then paused the shipments. Now we're seeing big relief, but the company is still down more than 80% year to date. RBC Capital Markets are saying this is taking the edge of solvency, but it won't eliminate its challenges. The drug will likely still be used less, so definitely more pressure going, but big relief today. And one company that is seeing a lot of pressure today is UPS. Big drop after the parcel carrier declined to provide full-year revenue or operating profit guidance. It's based on macroeconomic uncertainty. They're talking about the housing market putting pressure. They're saying how they expect their big supply from the U.S. to eventually pay off, because obviously they don't have those tariffs, but this is not yet happening. It's struggling to recapture the volume it experienced during the early years of the pandemic. Obviously, the company has had to reorient to smaller volumes, closing and consolidating facilities, reducing headcount, but so far this hasn't really helped. The company is still down 24% year to date. Another company that is suffering today is Whirlpool. It slashed its 2025 profit outlook and the stock tumbled 11%. It's expecting boost from its US sales, but what we're seeing is that a lot of their rivals have rushed to import into the country, and that's putting pressure for the company. This is obviously short-term pain. The CEO says that long-term, they're going to benefit from actually Trump's aggressive tariff policy, just because the majority of their production is actually happening in the US. That said, we're yet to see if that will materialize. The company is down more than 20% year to date. Back to you, Katie and Matt.
Yeah, going down the drain there, Whirlpool shares down 11%.
You didn't.
Denitsa, you didn't, but I did. That is Bloomberg's Denitsa Sikova. Yeah, really interesting stories on the single stock level, even though the index is pretty chill right now.
Well, chill, but a continued ratcheting higher and higher and higher.
By a sneeze or so.
I mean, the fact is that we were looking at so many people lowering their estimates to less than 6,000, and now we're at 6,400.
John Stoltzfus, 7,100.
Back up to 7,100. Mike Wilson leaning more and more towards 7,200 in the second quarter of next year. So we continue to see a ratcheting up, although, yeah, it's incremental, the gains.
Yeah.
Coming up.
The IMF sees the world's precarious trade backdrop hurting global growth. The fund's chief economist joins us next. Not a conversation you want to miss. This is Open Interest. The IMF warned this morning that the world economy will keep weakening even as it shows some resilience to trade disruption. It now sees global growth decelerating to 3% in 2025. IMF Chief Economist Pierre-Olivier Gourinchas is with us now to talk through it. Great to have you with us. Before we get into the specifics of your forecast, I want to talk about the business of forecasting. It's a conversation Matt and I were just having in the context of Wall Street sell-side strategists, but it sounds like it's something that economists are running into as well, that as the goalposts of trade policy and trade discussions keep changing, it's difficult to keep up.
Well, it certainly has been quite challenging in the last few months, and since our April projections in our spring report, and even in the WEO update we're just having, we see developments almost day by day. We had announcements on the US-EU trade deal. We had the US-Japan announcement not so long ago, and I could go on and on. And so, of course, we are trying to take all of that on board as best we can, but at some point we need to stop the clock and see where we are, and that's what we're doing with this WEO update.
So we see from your update that the global economic growth expectations are diminished versus the expectations previous to Liberation Day. Do you see a recovery in the next few years? Because I think the Trump administration all along has said there will be some pain shorter term in order to rearrange global trade longer term.
Well, what we are seeing is sort of a glass half full, glass half empty kind of situation. We are seeing a modest upwards revision in our growth projection compared to April. But April, when we had our last round, was really at a point where the tariffs that were announced were very elevated on a number of countries. And so some of the upwards revision we have, some of the upgrade, is on the back of the modest easing of trade tensions. So that's the glass half full. The glass half empty is that even with this modest easing, the tariffs are here, and the tariffs are sizable. We are expecting tariffs of the order of 17%, sort of the average tariff of the US on the rest of the world. We were at levels that were less than 3% when we're as of last year. So very sizable increase in the level of tariffs. And so when you compare where we are now compared to where we were expecting to be before tariffs were announced in early April, then growth is actually revised down. Now, where is it going to go? Well, we're here. The important thing to keep in mind is medium-term growth has been relatively weak in the recent years, and it's expected to continue being weak. We have much lower long-term, medium-term growth than we used to have, let's say, 10, 15 years ago. And so that's a concern here, is that the tariffs are actually going to add to that tepid, mediocre, medium-term growth and may not necessarily be reverted anytime soon.
Let's talk specifically about the U.S. because you raised your GDP outlook for 2025 to 1.9% and then a very slight acceleration to 2% growth in 2026. And it feels like with every important economic release that we get, we take out our magnifying glass and we try to find tariffs and trade policy somewhere in those releases. And you think about the U.S. economy specifically, it feels like the labor market is holding up. It feels like inflation really has remained under control. But taking a look at the numbers that you put out this morning, it sounds like where we could see the impact is just in overall robustness and overall growth of this economy.
Yeah, so we're seeing a slight uptick in growth for the U.S. in 2025, 1.9%. Some of that, again, reflects the fact that the tariffs are not as bad as they were expected back in April. That is helping a little bit. What has helped also the U.S. economy is an easing of financial conditions. Equity markets have been doing really well and have more than recovered since the April first few weeks of April, when we're seeing also a depreciation of the U.S. dollar. That depreciation of the U.S. dollar is helping amplify, in effect, the tariff shock, because it's making foreign goods more expensive, both because in their own currency they are now becoming more expensive when you convert that into dollars, and also because they're facing the tariff. So it's amplifying the tariff shock, and it's making U.S. goods more competitive. So that is also helping a little bit. But then the other thing that you have is, of course, the budget bill that was just recently passed. That is going to have a modest expansionary effect on the U.S. economy, especially in 2026. That's behind the upward revision we have to 2% for next year. So now, stepping back, do we see the effect of the tariffs yet? Well, it's starting to appear, but it will be building up. Where do we see that starting to appear? Well, we see that when we're looking at the impact of the tariffs on domestic prices. We're seeing some signs of transmission into domestic prices when we look at the June CPI, and we expect that will continue. And when we're looking at the effect of this tariff, the import prices in dollars for foreign goods that are brought into the U.S. have not decreased. So the impact of the tariff comes on top, and the tariffs are effectively, at this point, this could change, but at this point, they are likely to be paid by the importers, the distributors and retailers, and eventually by customers who have to pay for those more expensive goods. And that is going to increase production cost in the U.S. That is going to be passed on to prices. That's going to be the channel through which it's raising price pressures in the U.S. economy. But it's going to take time. We expect that to unfold in the second half of the year and into next year.
Pierre-Olivier, I want to step back and ask a broader question. While you were getting your PhD at MIT, or rather a decade before that, Peter Navarro was across town at Harvard studying why capital moves where it does. Can you understand what this administration is trying to do? I mean, can you sort of get it intellectually, or do you think they're going wrong?
Well, I think the way I would approach your question, and you're referencing to the Stone Age here, back when I was doing my PhD, so we're looking at a long, long time ago. But
it was the 90s.
The big question here is the U.S. Is concerned about its external deficits, its trade deficit, which is mostly in goods. In services, it's not necessarily the case, but overall, its trade and current account deficit. It's concerned about that. It's a legitimate concern. In fact, this is one of the things that we at the IMF watch very closely. If you're running a deficit, then other countries are running surpluses. We know where these surpluses are. And here I'm looking at global deficit and surpluses, not the bilateral ones. And we know that some countries have large surpluses. You look at China, you look at the European Union. So there is a question about whether deficits and surpluses can be too big. And that's something that we look at very closely. Now, our assessment is that tariffs and trade policy as has been implemented has very little chance of actually significantly reducing these deficits, these external deficits of the U.S. Why do I say that? Well, because when we look at what's driving this, it's mostly coming from domestic policies that are contributing to these deficits. And chief among them in the U.S. is fiscal policy, a fiscal policy with 6-7% public deficits in the last year, expected to continue with the budget bill that was passed, where some of the additional, whether tax cuts that have been implemented, will be partly offset by tariff revenues, but on net, it still will add to the debt. And this is, to us, this is the primary way in which this external deficit should be addressed, not through raising tariffs, which is like throwing sands in the wheels of the global economy, is making everyone worse off.
Shooting another hole in the boat, as Milton Friedman, I believe, would have said. Thank you very much, Pierre-Olivier Gourinchas of the IMF. This is Open Interest.
Novo Nordisk is plunging after it cut its full-year guidance in a surprise update, citing weaker than expected Wegovy sales. The drug maker also named a company insider as its new CEO. Let's discuss with Michael Shaw. He covers biotech, pharma, and healthcare for Bloomberg Intelligence. And Michael, you see shares of Eli Lilly, for example, falling in sympathy with what we're seeing in Novo today. So I want to ask, is this Novo losing share, losing ground, or is this an issue for the overall GLP-1 market?
I mean, I think the direct read-through for Lilly is quite limited. It seems more of a Novo issue in the sense that the guidance cut was basically driven by headwinds to Wegovy through compounded GLP-1. Now, we thought that these headwinds were going to ease in 2Q. There are about 1 million patients on compounded GLP-1 in the first quarter. The fact that Wegovy is off the shortage list and that the FDA grace period for compounding manufacturing has ended, all of that kind of spoke to that headwind easing. Now, there's a lack of visibility around compounded GLP-1 and how many patients are on it. And unfortunately, we didn't see that materialize. And that's largely the reason for the guidance cut for Novo today.
Wow.
Yeah.
I feel like they could make some partnerships and sell that. Michael, we'll come back to you and talk more about this when we have more time. Running up against the break here, Michael Shaw of Bloomberg Intelligence talking to us about Novo Nordisk. I feel like they could make some partnerships like on Instagram and then do like microdosing of Wegovy.
Yeah, they have made partnerships, particularly with CVS, for example, but definitely tough sledding for Novo Nordisk. We do have some breaking news from the Fed saying that Governor Adriana Kugler is not attending this week's meeting due to a personal matter. I will note that means one fewer voter at this meeting.
One fewer.
One fewer, not one less, one fewer.
That's right. Coming up tomorrow, former Goldman strategist Abby Joseph Cohen joins us, as well as Jeff Aronson of Centerbridge Partners. We may be looking at a new record, but for now, the S&P is lower. This is Open Interest.